Catherine with the team of Keller Williams Realty. We are on with Peter Martino with Guaranteed Rate. Hey, Peter, how are you doing today?
I'm good, Catherine. How are you?
Good. Thanks so much for hopping on with me for this meeting and just going over what the market is doing with the mortgage rates and how that's affecting home buyers right now, as well as home sellers. And if you would just kind of share a little bit about yourself, your experience in the industry, as well as your company and the products that y'all specialize in.
Okay, great. Thank you. So I'm Peter Martino, Guaranteed Rate, as Catherine said, and I've been in the mortgage business for about 37 years. And we are in a transitionary economy right now. It's been strange the last few years because of COVID, and the markets have changed and interest rates have changed drastically. We all know that by now. And most of us that have been used to rates in the low threes and even high twos and mid twos, it's quite a shock that we're now near 6%. And how did we get here? Why is that happening? Where is it going? Everybody wants to know. And I can give you some basic information about what's happening and sort of an outlook on the future and what we might be seeing over the next few quarters and into 2023.
Great. That's awesome.
Yeah.
Well, let's dive in. So you've mentioned the biggest question. We went from these historically low interest rates that were crazy. I remember just a year ago, we had one client that actually locked in at a 2% interest rate. The banks were giving away money.
It was insane.
Which we knew that was not going to last long. And I'm curious to know, like, how did that even happen? 2% interest rates to 3% interest rates, and what was the journey to get us to more of what we were used to seeing, which pre-pandemic, I mean, when I first started in 2013 selling real estate, I remember putting into the VA contracts that this offers contingent upon interest rates not to exceed 4.75, or when I was very first starting out, we were seeing more about 5.25 interest rates. So, now we're kind of seeing those numbers again, and everyone's mind is blown and thinking that that's just crazy and really high. But I mean, thinking about it, just a few short years ago, that was what we were seeing. So give us a little bit of a breakdown of that journey that we've just gone through, this roller coaster.
Okay, well, I'm going to go back a lot further than 2013 because, like I said, I've been doing this forever, and I was in my 20s when I started, and I had dark hair. So for those that could remember the late 70s and early 80s, we had extremely high inflation, and we're going to talk about inflation. Inflation was about 13%. Today, it's about 8.5%. Mortgage interest rates peaked at about 18%. Can you imagine? I mean, we're crying at 6%, but can you imagine 18%? I can't. When I got into the business, it was the first refi boom, because by the time I got there, we had gotten down to about 13, and then they were in the 10s and 9s, and everybody was refinancing, and it was very similar to what happened during the pandemic. But here's the bottom line. In a word, inflation. Inflation is a killer for mortgage rates. So we're going to talk about the Fed funds, and we're going to talk about what the Fed is doing in raising rates. And we're also going to talk about how that's good for mortgage rates, which is very counterintuitive because you think if the Fed's raising rates, everybody's going to pay the penalty. It's actually a good thing. So what happened was, in each and every time we've seen high inflation, the Fed raises rates because that stems the tide of inflation. It slows the economy. We typically go into a recession. We are on the cusp of one right now. We could actually already be in one right now. We're waiting for the second quarter numbers to come out. When inflation happens, it kills the value of a bond. And mortgage rates are based on mortgage-backed securities, which is a bundle of mortgages that are sold on the marketplace as an investment, and it's considered a safe investment. And since it's a fixed return, inflation reduces the value of that bond in the future. So therefore, as bond values go down, interest rates go up. And that's what's happening right now. This inflation right now is killing mortgage rates. Okay.
Okay.
So what the Fed is doing right now is trying to stem inflation. They just raised rates of 0.75%. Well, before that, they did a half, then they did another half, then they did 3/4, and we're expecting them to do another 3/4 this month. So that slows the economy. Everything costs more because of inflation. We're paying for it at the pump. We're paying for it at the grocery store. It's impacting how we use our discretionary funds. So as things are slowing, low demand, high supply, we're going to get that more in balance. Inflation comes down, mortgage rates will come down. Now, if you're going to go out to the store and buy a big screen TV or furniture or anything else, practically on the consumer end of things, it's going to be more expensive as the Fed raises rates. Financing on the consumer end of things is going to be more expensive. But not a direct correlation to mortgage rates. Inflation is. So as inflation comes down, rates will come down.
So that's why they are raising the rates, is to try to control the inflation and get
Correct.
the inflation down. So it might, not be ideal for home buyers right now when we were getting those 3% interest rates. But in the long run, this is going to help the economy, and it's also going to help stabilize the housing market.
Yes. And historically as well, housing and rates have done well in periods of recession. That's been proven time and time again. I want to show you a quick chart here to just explain something a little bit further. And so in this chart here, this black line is the yield curve. And every one of these dots represents a bond. So this is like a 1-month bond. This is a 2-month. This is the 3-year, 5-year, 7-year. 2-year, 3-year, 5-year, 7-year. This is the 10-year right here. The 10-year bond is lower than all of these other short-term notes.
Wow.
What we have here is an inverted yield curve. And historically, an inverted yield curve, meaning long-term rates are lower than short-term rates, is definitely one of the signs of recession. So it seems pretty clear that this is where we're headed. And when we see, so for those people that are interested in like adjustable rate mortgages, which has usually been a really good tool during times of rates going up, we're seeing ARMs not being as priced effectively against the 30-year fixed or a 20-year fixed as they had been in the past. So that's kind of working against us right now. So again, this is not to be something that's going to be fearful in terms of housing, because as I said, as the Fed makes these moves and they raise rates, we are going to see rates come down. We are going to see housing stay stable. Home prices are holding on to their values. And one thing that is abundantly clear, this is not 2008. This is not a market where we're going to see massive depreciation, where we're going to see massive foreclosures.
I'm glad that you said that, because that is like the #1 question that I get from home buyers. They're like, we're so scared to jump and buy right now because of how much home values have increased, especially in Brunswick County over the past 2 years. But this is not a 2008 situation. It is not a housing bubble or where it's just going to come all crumbling down. The builders are suffering. In fact, new construction is just booming here, and we're having steady growth with that as well.
Right, right. Anybody that drives around Brunswick County and sees all these developments going up everywhere knows that this county is booming. And so a lot of what I talk about is their national statistics, but real estate is local to each market. There's always a local component. And in the Midwest, you know, it's always a little bit more conservative, and you don't see the high highs and the low lows. It's always kind of stable. On the coast, it tends to run a little bit higher in both, you know, extremes. And in Brunswick County, we saw like 25% appreciation year over year from 2021 to 2022. Are we going to see 20% appreciation in real estate? No. But are we going to see negative 20% depreciation? No. We're going to probably be more normal, anywhere between 2 to 4%, you know, as things slow. They're naturally going to slow. But we're not going to see, based on these national statistics, we're not going to see a housing bubble. I don't believe that that's what's in the future.
That's good. That's what I've been reading and following as well. Because for a while there, it was a little crazy. I was calling it the wild, wild west market. No one knew what in the world. And when COVID first hit us, I was not sure if we would even make it, if I was going to have to go and get a job down at McDonald's or something.
I know. It's scary. It's crazy. And then we had this ridiculous year during the pandemic. Rates went so low. So going back to what happened to rates, there's one thing that in my career that happened twice. And it happened after the mortgage meltdown and housing bubble of 2008. And then it happened again in the pandemic. And there's this term, which some may know, it's called quantitative easing. What is quantitative easing? Quantitative easing is when the Fed buys billions of dollars of bonds. They'll buy 10 years, they'll buy 30 years, they'll buy mortgage-backed securities, and they will just buy all of these bonds and artificially keep rates low. That needed to happen during the mortgage meltdown and housing bubble because everybody was losing their homes. Everybody was underwater. When I say everybody, it was the majority. When you owe more than your home is worth, and rates were about 6% at that time, they came out with the refinance program where they allowed you to refinance your mortgage, and even though you were underwater, you know, just anything to help support the housing market so it didn't completely crumble. It crumbled enough, but not to obliteration. So they did that. Rates came down. We refinanced everybody. Should have. A lot of people didn't, but vast majority did. And then when you free up $200, $500 a month, even $800 a month in housing costs, well, where does that extra money go to? It goes back into the economy because the consumer is 2/3 of our GDP. So if people are spending, then the economy can recover. Now, when the pandemic occurred and our economy basically shut down, we had to flood the market with liquidity, low rates, buying bonds that did it again. And so now, and we saw those even lower than the first time, we saw rates even lower. So, you know, somebody had a 3.5 rate, now we're lowering them to 2.5. It's like, wow, this is like, you know, unbelievable. It's Christmas every day. And everybody took advantage of it, and hopefully they did. So for the folks that are out there now that are on the fence, I heard something about 3 weeks ago, and I love it. And it's marry the house, date the rate. If you love the house, buy the house. Your rate might be not where you want, but don't let that scare you away because we're going to refinance that loan probably within the next 2 years.
Exactly. I think that you were the one that shared that with me. We had a client that we were working with, and you know, they weren't too happy about the rate, but they loved the house. And you know, with the way that this area, especially Brunswick County, we're seeing home values, they're not increasing the way that they were, like you mentioned, over the past 2 years, but home values are going to continue to increase here. And so, you know, it's easier to go ahead and refinance in a year to 2 years.
Yeah.
and
Yeah.
get that interest rate lower than
Right.
lose out on the house.
Right, exactly. Yeah, so, when that person, they actually benefited because they switched their program to a VA loan. And it was right at a point in time where rates had a little bit of a dip,
Yep.
and they were able to relock and capture a much better rate. So that was extremely happy for them. But the rate's still over 5%. And when we have short memories in our society, in our culture, and we just remember what we knew yesterday. And I think a lot of what's happening is an acclimation to the future, that those 2% and 3% rates, they're gone, at least now. Will we ever get there again? Nobody really knows. When we got there the first time and then they went up to 5, I thought, well, we'll never see those again. And they went even lower. So I never say never anymore. It's been a wild ride for the past 10 years in this industry. And I continue to be hopeful that it's going to happen again. I want to share one other chart with you real quick.
Okay.
And this one kind of goes towards what I was mentioning regarding inflation and rates. Okay, so every dark line is recession here, and this is a recession versus unemployment comparison.
Okay.
So unemployment figures came out last Friday, and they were way better than most economists had anticipated. And so that was a rally for stocks, and stocks and bonds in general kind of work opposite of each other. When stocks rally, bonds generally pay the price.
Yeah.
And when stocks are not doing so well, for reasons mostly because they're more risky, then the safe haven is to buy a bond, which includes mortgage-backed securities. So this unemployment number came out. It was positive, and there was a lot of trading on it, and bonds sold off, and stocks rallied a bit last week. So what I'm showing you here is that at the bottom of every trough, right before an inflation starts, a recession begins, we are at the bottom, or the best, let's call it, of employment figures at that time. And
Okay.
it happens every time, and you can't see the date on this because it's cut off at the bottom, but this first one is like going back to the 50s, and this is the present. So this has historically proven itself over and over and over again. Now, we had super high unemployment because of the pandemic, and then as that eased, it came crashing back down again. So, that's a one-off. The last pandemic was 1920, right? The Spanish flu. So hopefully we're not going to have a pandemic for another 100 years. Okay, that would be fine in my book. But the point I'm trying to make here is that in recessions generally begin when unemployment looks its best. And as the economy slows and businesses don't continue to hire or actually begin to lay off, that's when during the recession, all these, each and every time unemployment went up. So I think we are on the cusp of it, but as I said earlier, housing will remain solid. Interest rates should come down. Mortgage interest rates should come down based on the Fed's continued activity, and they are being very hawkish on their policy for rates. So I just think that it's a good time to buy. I think that if you wait, and you can speak to this better than me, Catherine, but if we wait and housing goes up 2%, well, you just paid more for the house that you could have got today, and we'll refinance that mortgage next year. So don't wait.
Yep. Well, thanks so much, Peter. I really appreciate you going through this whole journey and, kind of dissecting it and breaking it down for the audience to kind of understand, and home buyers. And this is important information for anyone, whether you're looking to buy, sell, invest, or just do nothing. It's important to know what these numbers and what the market is doing, because a home is your largest investment that you make, and you always want to protect that. So thank you so much for sharing the information. You guys, Peter Martino with Guaranteed Rate. And at the end of this video, we'll go ahead and we'll drop the contact information down below. Y'all have a great day. Thanks so much.
Bye-bye. Thank you.
Bye.